Is O'Reilly Automotive about to hit a roadblock? The auto parts leader announces earnings tomorrow, and there's one critical number that could send the stock crashing or soaring. I'll show you exactly what to watch for. O'Reilly has outperformed the market with a stunning 17% gain this year, but Wall Street is divided on what happens next. This earnings report comes at a critical junction as O'Reilly navigates inflation pressures and intensifying competition. Let's break down what you need to know. For those new to the stock, O'Reilly is America's leading auto parts retailer with over 6,000 stores and $16.7 billion in annual revenue. The company serves a dual customer base, 55% DIY consumers and 45% professional mechanics. This balance gives them unique stability compared to competitors. Currently trading at $1,368, O'Reilly sits about 6% below its all-time high set in February. The stock is up 44% from its 52-week low, showing strong momentum. But here's what's interesting. It's currently trading near its 50-day moving average, making this earnings report a potential inflection point. The numbers don't lie. O'Reilly has crushed the S&P 500 this year with 17.3% gains versus the market's 7.8%. What's even more impressive is the stability. With a beta of just 0.18, it's delivering these returns with minimal volatility. This defensive growth profile is why institutions keep accumulating. Analysts expect $4.53 billion in revenue, up 13.9% year over year, with EPS of $9.87. But here's what everyone's focusing on: comparable store sales growth between 3.8 to 4.2%. This single metric will likely determine whether the stock pops or drops after earnings, as it reveals true organic demand strength. Last quarter showed the company's resilience. Revenue beat expectations at $4.10 billion, though EPS slightly missed. What's fascinating is that despite the earnings miss, the stock actually rallied 3.16% in the following week. Why? Because investors focused on revenue growth and professional segment strength instead. O'Reilly's revenue shows a clear upward trajectory with the massive Q1 acceleration to 13.9% growth expected tomorrow. The 5-year compound growth rate of 10.5% demonstrates consistent execution even through economic headwinds. This predictability is what commands the premium valuation. The company's earnings show a distinct seasonal pattern. Q2 and Q3 typically outperform Q1 and Q4. But look at this. While revenue grows at 10.5%, EPS has grown at a whopping 17.9% annually. This spread reveals management's skill at expanding margins and aggressive share buybacks. Comp sales, the most critical metric for retail investors, have been gradually decelerating from 4.5% to 3.25% over the past year. However, they still remain well above industry average by 1.3 percentage points. Tomorrow's number needs to hit at least 3.8% to maintain momentum. O'Reilly maintains industry-leading profitability with gross margins of 51.2% and ROC of 60.8%. A staggering 6 times the market average. Even with slight margin compression from inflation, the company's return metrics justify its premium multiple. Few retailers can match these economics. Don't be alarmed by the negative equity of $1.37 billion. It's actually a sign of shareholder-friendly policies. The company has spent over $24.5 billion on buybacks since 2011, reducing share count by 27%. With debt to EBITDA at just 1.48x and interest coverage of 15.2x, the balance sheet remains rock solid. Money talks, and O'Reilly generates $2.03 billion in annual free cash flow, giving it tremendous financial flexibility. Over 65% of this cash goes to share repurchases, driving that consistent EPS growth. With an FCF margin of 12.1%, the business model is extraordinarily capital efficient. The company's capital allocation prioritizes shareholders, 65% goes to buybacks, 20% to new stores, with the remainder split between technology and distribution. This discipline has reduced share count by 5.9% annually, creating a powerful EPS tailwind regardless of economic conditions. Now for the elephant in the room, valuation. At 33.7x earnings, O'Reilly trades at a 42% premium to its historical average and 121% above industry peers. This premium multiple leaves little room for error, setting up a potential volatility spike if earnings disappoint even slightly. Among competitors, O'Reilly leads in revenue growth at nearly 3x the industry average. While AutoZone edges out in operating margin, O'Reilly dominates in growth metrics. The two form a clear top tier in the industry, with O'Reilly commanding a higher multiple due to its superior growth profile. This chart tells the story. O'Reilly's premium valuation has expanded significantly in recent years. The current fair value range of $1,320 to $1,435 suggests limited near-term upside at current levels. The stock has simply priced in a lot of the good news already. The key secular tailwind driving the entire sector is the aging vehicle fleet, now at a record 12.6 years and rising. This trend creates a perfect environment for parts replacements. However, long-term challenges from e-commerce competition and eventually electric vehicles could pressure margins. O'Reilly's true moat comes from its superior supply chain, parts available within 30 minutes through its hub-and-spoke distribution network. With 93,000 plus trained professionals and 6,000 plus stores carrying 142,000 plus parts, the scale advantages create a virtuous cycle competitors struggle to match. The company's growth algorithm is straightforward: 150 to 160 new stores annually, 2.5 to 3% growth, 3 to 5% same-store sales growth, and expanding professional customer business. Mexico expansion represents a significant opportunity, targeting 500 plus stores by 2027 versus just 73 today. Management is executing a balanced portfolio of customer-facing and infrastructure initiatives. The highest impact near-term projects include omni-channel integration and professional customer experience enhancements. The company consistently delivers on operational execution promises. Recent catalysts include Truist's note about potential tariff benefits and Wells Fargo's price target increase to $1,550. The proposed 15-for-1 stock split announced in March could increase retail investor interest. These catalysts could provide support regardless of earnings quality. From a technical perspective, the stock is maintaining its bullish trend despite recent pullback. Key support sits at $1,350, while resistance remains at the all-time high of $1,458. Watch for a break above $1,400 on high volume as potential confirmation of renewed uptrend ahead of earnings. Wall Street is largely positive. 70% of analysts rate O'Reilly a buy or outperform, with an average price target of $1,429, suggesting modest 4.4% upside. Recent price target increases trend positive, with Wells Fargo's $1,550 target representing the bull case. The spread between the lowest $920 and highest $1,600 price targets reveals significant disagreement about the company's fair value. The consensus points to moderate upside, but this wide range indicates uncertainty about the sustainability of growth rates and margin expansion. The biggest risk is valuation. O'Reilly's PE ratio is 121% higher than the industry average. This premium pricing leaves virtually no margin for error. Any earnings growth deceleration could trigger multiple compression, potentially creating a sharp correction despite fundamentally sound business performance. Competition is intensifying from multiple fronts. Amazon and other e-commerce players continue gaining share, while traditional competitors improve their capabilities. The DIY segment faces particular pressure from online alternatives, making professional customer growth increasingly critical. Macro risks include potential recession reducing miles driven, persistent inflation hurting consumer spending, and rising interest rates affecting auto financing. The emerging risks of ride-sharing reducing car ownership and electric vehicle adoption lowering maintenance needs represent longer-term threats. Execution risks include store expansion challenges, supply chain disruptions, and inventory management issues. However, the company's historical execution strength in consistently opening 150-plus stores annually with the hub-and-spoke distribution model optimization provides confidence. The bull case would see comparable sales exceeding 5%, gross margin expansion despite inflation, and accelerated Mexico expansion. Under this scenario, the price target reaches $1,600, representing 17% upside. Key catalyst would be stronger than expected DIY segment performance. The bear case involves comps below 3%, margin compression from rising costs, and slowing professional segment growth. This could trigger multiple compression to $1,100, representing 20% downside. The risk grows if full-year guidance disappoints, as the premium valuation leaves little room for error. Our base case assumes comps of 3.5 to 4.0%, stable gross margins, continued share repurchases, and modest guidance increases. This scenario supports a $1,450 price target, representing about 6% upside. The real question is whether this modest return justifies the risk. For conservative investors, patience is key. Wait for post-earnings clarity or pullbacks to the $1,345 support level before establishing positions. Dollar cost averaging on weakness provides a disciplined entry approach. Position sizing should remain at 5 to 7% maximum given valuation risks. For aggressive investors comfortable with higher risk, a bull call spread strategy buying the $1,370 call and selling the $1,450 call limits downside, while providing 208% maximum return if the stock rallies post-earnings. Technical-based entries on bullish patterns can also optimize timing. The long-term investment thesis remains compelling despite near-term valuation concerns. The company's consistent track record, industry leadership, aging vehicle tailwind, and disciplined capital allocation create a sustainable competitive advantage. The 10-year revenue CAGR of 10.5% speaks volumes. When earnings drop tomorrow, focus on these critical metrics. Full-year guidance, 95% importance. Comparable store sales growth above 3.8%, 90% importance. Gross margin stability above 51%, 85% importance, and professional versus DIY segment growth rates, 80% importance. After earnings, watch these key technical levels. Support at $1,350, recent consolidation, $1,300, psychological level, and resistance at $1,458, all-time high. A break above $1,400 on high volume would confirm renewed upward momentum. Our verdict: hold with selective accumulation on weakness. While O'Reilly remains a best-in-class retailer with exceptional fundamentals, the premium valuation limits immediate upside. The risk-reward balance suggests caution ahead of earnings, with the upcoming report being the critical catalyst. O'Reilly represents a high-quality business, but at a stretched valuation. The limited margin of safety means tomorrow's earnings will be decisive. For long-term investors, O'Reilly remains attractive for portfolio inclusion, but patience in establishing positions will likely be rewarded. I'd like to hear your thoughts in the comments below. Is O'Reilly worth the premium multiple? Are you buying, holding, or selling ahead of tomorrow's report? Hit the like button if this analysis helped you, and don't forget to subscribe for more stock breakdowns. Thanks for watching.